Today, we are talking about a handful of things that we learned from the past couple mastermind events as we're leading up to the live events in 2026. Check it all out now.
Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey guys, thanks for checking out the show. We do appreciate it. If you have been following this podcast for a while, first of all, thanks. Thank you. Watching, listening, we really appreciate it. It's why we do it. And also, you might be thinking about coming to one of our live events. If you've been following our material for a while, you're actively lending. If you're curious, talk to Dave Bauer, our program director, about it. Just go to hardmoneymastermind.com, click on live events, schedule a time on his calendar to speak, and he'll tell you about everything that's going on. We do have a couple coming up that are already scheduled, one in May, one in June. Dave will tell you all about it. And now we're going to chat about observations. We've been doing this, 4 or 5 years of live meetings? 4 or 5 years, something like that. And I want to talk about, and the group has grown. The group has grown into multiple meetings. A lot of the same people have been in the room for a few years now. They've been growing significantly, some of them this entire time. And I want to chat about some of what we see going on. What we see going on that I think will be beneficial to anyone watching or listening, people who are actively lending private funds. So I'll start off with the first one. One observation, because everyone's operations are different, right? They're different sizes. They're different. Their teams are a little bit different. Some of the software can vary. We'll talk about a few things here. But one thing that remains pretty constant is that this business model works really well at all different sizes. You can be a 1 or 2 person show lending your own money at $3 million outstanding with a nice bottom line. You can have 12 or 15 million of investor capital doing co-lending, and you're just still growing, and your bottom line is good. You could be $100 million debt fund with a big team like our friends in South Carolina, and your bottom line looks good too. That's one of the great things about this business, is that the economics, you're not scraping for profit. The economics of this model is just profitable. The points, your own money, the spread on this, extension fees, late fees, whatever. It's just not that hard to bring in good profit.
Yeah, no, you're right. And I think, if you look at the bottom line numbers for everybody's operations, and again, I don't know the bottom lines of everybody's, but we have an idea because we've been all different sizes over the years, and I know what their team looks like and things like that. They're all in a good spot, but everybody's also motivated to grow, and they want to get bigger. When I say bigger, maybe not necessarily, larger funds, but like more profitable. Hey, what are ways that we can make more money? Do we have to charge more to the borrower? Do we want to, do more deals? I mean, honestly, a lot of people in that group are still at growth stages, and they want to grow, but I do think that they have a goal in mind of where they want to get to. One of the more profitable operations has about a $12 or $15 million portfolio at the moment, and their original goal was get to 25 million, but then they kind of went back a little bit and said, hey, you know what, maybe we should try to cut back a little on that goal, because I think we could reach our profitability. I know what they want to each make as partners a year, and they think they can reach that without actually hitting that 25 or 30 million. So that's good. So that was just kind of an extension to yours. One of the things that I know we talk about every meeting, which is a hot topic, is marketing and trying to find ways to grow and find opportunities. And, some members of the group, they are like, I'll do whatever it takes. I want to do everything on marketing. And some don't want to mess with the marketing stuff as much. And but they also have good budgets that they could potentially outsource it or pay for somebody. So the topics is still alike. And, one of the things that Chris and I have to do, it's one of our responsibilities of putting this group together, is helping some of our members with their marketing efforts and, making sure we're up to date on what's going on in the industry. The good part is we're doing marketing 90% of the day anyways. So that's an easy one for us. But, I'll look at some of the presentations. Some of the groups that we do have presentations, and it's very high educational. Other groups are more masterminding, right? It's just mastermind type of stuff. But like, I'll look back at my notes and what we discussed, or some of the presentations, and even within 6 months, the stuff changes. Like, we're a business that shouldn't change that much, but I think when you're in a growth phase, stuff does change, right? What was important to you 6 months ago might not be as important now, and vice versa. So, like, I'll look back and be like, oh wow, that's what we were doing for marketing. That was like the hot marketing. Now we're only 6 months later, and we've added this, or we added this, or we realized that didn't work, or we had better results here, and we're going all in on this particular thing. I mean, keep in mind, 6 months ago, we didn't have Go High Level. We pushed Go on Go High Level when we were in Atlanta, right? In November, right? So we're going to have 6 months in our next event. We're going to have 6 months worth of Go High Level data with 5 originators working out of it every day and inputting thousands and thousands of leads. We have a lot of data to share with the group. So it just goes to show that things change a lot.
Yeah, I mean, upgrades come when you really need them, right? Like, you can't be constantly upgrading everything all the time. Most of that isn't necessary, but especially when you've been in the business for a while, like, you make an upgrade that's really, really going to move the needle. And that's what, high level's doing for us. Okay. Next observation. Let's talk about constraints, like Hormozy does, right? Like, anytime he's looking at, in his consulting, looking at someone's company, he's like, all right, identifying where the constraints to growth are. And I would say that most of the room in our mastermind meetings, most of the room is still constrained by capital. You might not think that, because I said some stuff earlier, like $100 million debt fund and this and that, and they might not be. And I know there's some other people who are in the room who are not at all constrained by capital. Like, they have deep resources, but most of the room still is, which is interesting. And I guess that just goes with the growth trajectory. And since we've been doing this close to 20 years now, like, we haven't raised capital actively in so long that capital, it's there. There's more on the sidelines if we need it. Our constraints are people accepting our loan quotes. It's not even leads. It's that, like, we had tons of leads. It's good deals and borrowers, good properties, accepting our terms and loan quotes. That right there is our constraint. And it always will be, right? But yeah, just another observation, like, most of the room still, even though they have a good amount going on and they're very profitable, they're still constrained by capital.
Yeah. And, I think a lot of people, like, this isn't necessarily something that maybe we've learned from the mastermind. But I think other people have learned from the mastermind events, because we've are aware of this, because we've seen this and we've seen this fail. But I will say that a lot of the members, and this is actually, it starts as a negative, but it ends up being a positive, because they're smart people and they learn from this. But we've definitely seen members of the group grow way too fast, and look and have conversations with them when we saw this, which is usually like one of the first events when they come in, and we're like, wow, like, you grew really, really fast. You need to be very careful, because this could backfire on you. And then 6 months later, a year later, they get it back. They're back where they need to be. And that's something that I think a lot of people learn from the mastermind group, because, there could be 30 lenders in there, and a few of them are just like super fast and loose, just moving way too quick on stuff and not realizing what could go wrong, right? Like, keep in mind, let's say you're year one and you do 20 deals and you don't have any defaults, because, like, you're probably not going to have many defaults at the beginning, right? You don't have time for them to default. You haven't been in the business long enough for them to default. And you're like, well, I did 20 deals. These are great. I'm going to do the same types of deals again. Like, you don't know. You learn from mistakes. You don't learn until the mistakes shuffle through. They're not realized yet. You don't have enough deals that have cycled through. And we saw that on a few groups. And listen, we, obviously warned of, like, hey, you should be careful with this. You should look out to this. And then it's great, because the next time around, it's like, hey, I took your advice. We decided to, make sure we're pulling credit now, or we decided that we're going to make sure the borrower has a minimum down payment and enough cash into these deals. Right. So that's what, I think a lot of people have learned in the group, and they're good operators, and they'll figure it out. And listen, if it happens early on, you can kind of make up for it a little bit if you don't do it too quickly. But that's a big learning lesson in this is, let's see deals cycle through before you just kind of go all in with everything. And, it has to do with patience. I mean, listen, a lot of people in this business want this to grow quickly. private lending is not that sexy if you only do a deal here and there, right? There's just not enough money to be made, right? So you want to elevate your game and start moving forward, but you gotta do it responsibly.
Yeah. So another one, a trend that I've noticed related to software. Let's talk about software. So the room has been trending towards lender software, LENDR software. And I'm not saying that because they're a sponsor of our mastermind, which they are. Bryce, the founder, is a sponsor of the Hard Money Mastermind, but it's just a case that he, from everything we can tell, is making the best industry product. And so the room has been trending towards his software. Now, it used to be 2 or 3 years ago, I would have said Automator. And so like breaking down the three main ones. So you have TMO, the mortgage office that we use. We've been on forever. They've been around since the 80s. They have a good product for what we do. It's really solid. It's not all that innovative. They're kind of like set in their ways. They have a huge customer base, ton of revenue. The software doesn't develop all that much. But it's good. It's good, solid software. Our team is fully ingrained in it, and that's where we're staying for the time being. And then along came Automator. And Automator was doing some new stuff, adding some more capabilities in, developing quickly. But in a couple years ago, a lot of the room was using Automator, but everybody thought it was hard to use. And that continued to be the case. I think it's very powerful software. It's just freaking confusing to people. And we've seen it. We've seen people log in and do this and that, and we're like, we're not programmers, tech guys really, but we operate pretty well inside of software and the UI and the UX of Automator. And I don't mean to take a shot at them at all. I'm just saying feedback from our group is that people have been moving away from Automator and towards lender.
Yeah. And I agreed. No more to mention on that, but that's facts. I mean, that's just what we've seen. I mean, that's what's happened. I mean, we haven't influenced that. I mean, we've had opportunities to, share our experiences with a lot of things. And actually, here's another thing that just came to mind that I thought about. This wasn't my next one, but this is another thing that came to mind. Like, our job is to share our experiences. Like, that's what we do in our mastermind. That's what we do in this podcast. That's what we do in our mastermind groups. We share what's working for us and what doesn't work for us. That's just what works for us. Like, if it doesn't work for everybody, that's no problem. I mean, there was a few people that had some bad experiences with some vendors that we shared inside the mastermind group, and that's okay. They didn't have a good experience. We do have a good experience with them, right? And if we have so it is what it is, right? Like, we have a good experience. If I have a good experience with them, I'm going to share it. Somebody asked me who our attorney is that does loan docs, I'm going to share that. If somebody asks me, hey, who's doing your marketing stuff, I'm going to share that. If somebody asks me, servicing softwares, everything else, we're going to share that. Like, we're transparent. That's the purpose of all of this, is we want to be transparent on that. But at the same time, like, what we put into it, we might get out something different than what someone else might put into it. It might not work for them in that particular case. Also keep in mind, some of the stuff that we do, we have to be more conservative in our states because the foreclosure and the default process is so much harder than in some other states. There's other members of the group that are a little bit more aggressive on their deals because they've seen loans default and their process took 45 days instead of 8 months, right? So naturally, they could be a little bit more aggressive on that. So all of this stuff kind of works hand in hand, and you got to figure out what works, with you and what your personality type is, right? Like, some people might be like, hey, listen, I'm a workhorse and I like going to meetup groups and networking, and like, that's me. Like, I just want to do that all the time. And if that's them, that's great. That's going to give a much better result than someone who might be an introvert that doesn't want to go to meetup groups and talk to people. And they might be like, hey, I've got a good next egg of money. I just want to throw, and I don't have a lot of time. I just want to throw money at my marketing efforts. Great. That would work as well. And that's why, like, one of the first things that Chris and I do when we do some private training and consulting with folks is like, what do you want out of this business? And do you want to put money to it? Do you want to put time into it? I can show you how to find deals with money. I can show you how to find deals with time. It just depends on what you want out of this. And I think that's important. A big takeaway, and the reason that I think our groups have had a lot of success is it's not just us sharing our experiences. It's also other members of the group sharing their experiences and seeing behind the scenes of everybody's operations. Because like you started with, everybody's is set up different, and it's important to do that. And we have a pretty big vetting process to bring, group members together, because it's not just like, what can you get out of this group? It's what can the group get out of you? Like, that's important. This isn't like a pay to play, like, hey, just pay the fee and you're on the team. It doesn't work like that. Like, you need to be someone that can bring value to everybody else. And the other really good part about that is we've had some newer lenders come into some of our smaller groups in the past, and they bring a ton of value because they're still killers in life. Huge real estate agents, huge business owners, huge mortgage broker companies. Like, they might only have a few $1 million deployed, and they might be on the earlier stages of private lending, but they have so much other value that they can bring to the table to help, their peers.
All right, here's another one that I've noticed at HMB and definitely in the mastermind, is that it is normal and common to dabble in some side deals and side revenue type of stuff. And I'll explain what that means in a second. But eventually, inevitably, everybody always ends up coming back to the core business model and focusing on that. To tell you what I mean, when you're getting a bunch of leads, when you're getting a lot of leads, and a lot of them you're not going to close with your own money. It's not your bread and butter. It's not your core business. It is completely normal to have the thought of, why don't I broker these out? Maybe this is a ground up construction in a state where I don't do. Why don't I broker this out to an institutional lender? Or, hey, I know my core business is lending private money, but my borrowers still use DSCR loans. Maybe I should dabble in DSCR. Or maybe I have this employee and the servicing software and it's all set up. Maybe I should service loans for other lenders. Or I have this part of my team and we process and document and complete files really well. Maybe I should process loans for other lenders. And inevitably, it's happened to us over the years. It's happened to other members of HMB, and it's happened to a number of people in the mastermind. One by one, you let all of those things go and just refocus in on the core model of lending private capital on the deals that you know well and control and everything else. Why? Because, I know that, look, I'm leaving money on the table if I have this opportunity and I don't take advantage of it. It's normal to feel that. And okay, but how much money are we talking about that's being left on the table, and how much work goes into it? That's usually, the economics of a business, the money model, like Hormozy says, ends up being everything. In the private lending money model, the recurring one that comes in, the stuff that comes in at closing, the stuff that comes in at the time of payoff, is really, really solid. And when you compare that to these other little fringe parts of the business, those money models, how much work is it going to take to package and process and DSCR and process and close a DSCR loan with an outside lender? And how much money you're going to make? It's not the same money model. It's going to cost you 5 times the time, and you're going to make 1 point or maybe 2 points instead of 6 points. It just doesn't, the money model doesn't work. It's exactly why people end up back in the core model.
No doubt. All right, well, we went on a rant in a few different directions, but
It's good. No, it's good. It's good. I mean, we learn a lot of stuff from this group. It continues to grow. We have, like I started with, we have 2 events coming up this year. One is May in Charlotte, North Carolina. One is here in Maryland, in our home market, in our backyard, in June. So go check them out. Talk to Dave about it. Go to hardmoneymastermind.com, click on live events, schedule a time to talk to Dave Bauer. He'll walk you through all the details. We hope to work with you in person, and we'll see you here next time on the podcast.
Thank you for joining us on this Private Lenders Podcast episode. Please note that opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, financial, and accounting professionals. If you enjoyed this episode of the Private Lenders Podcast, we would appreciate it if you could spread the word. Make sure to check out hardmoneymastermind.com, the #1 community for all private and hard money lenders.